on completing the accounting cycle. So what we'll be introducing in this chapter is the end of period spreadsheet. So the ability to take the unadjusted trial balance, which the unadjusted trial balance is all the account ledger balances from the T accounts that came about based upon the day in and day out analysis of business transactions, classifying them into a minimum of 2 accounts, and then recording them in the general journal, and then taking those journal entries, posting them to the account ledgers. We then can make a whole series of adjustments, and next Monday's class and next Wednesday's class will be me doing a sample problem on the computer on Excel, showing you how to go about doing that. There is also under Chapter 5 on Blackboard a video, a screen capture video of me doing the same thing. So one of the 40 points of the total 500 is an Excel assignment, and that is posted on Blackboard under assignments. And so you're to take a blank Excel spreadsheet, create this end of period accountant spreadsheet, and then do a series of adjustments, come up with the adjusted trial balance, and from that do the income statement, the retained earnings statement, and the balance sheet. So in this slide is just showing you the interconnectivity, because net income feeds retained earnings. Ending retained earnings is a section of the stockholders' equity. All right? So the spreadsheet has 6 basic columns. So it has the unadjusted trial balance, both the debits and the credits. So the debits will be the assets for the most part, plus all of the expenses associated with the income statement. And then the credits, which are the liabilities, the stockholders' equity, the revenue accounts. Debit would also be the dividend. From that, you can make adjustments, a series of adjustments to do your accruals and deferrals. So deferred revenue, deferred expenses, those are revenues and expenses where cash has already changed hands. You have already received the cash in the case of an unearned revenue, unearned rent, or passenger liability in the airline business when airlines accept your reservation and you make the payment. And then accruals. So accruals, cash has not changed hands. So this is revenue that has been earned. You have completed the revenue process. You have not yet billed your customer. So you need to send out an invoice, and on the last day of the month or during the adjusting process, which normally occurs the week after, you need to go through and recognize this revenue that you've earned. Expenses, things like utilities, taxes, interest, wages and salaries, all of those that have not yet been paid but has been incurred. So your employees have worked, they've earned those wages, they've been generating you revenue while they work, so it's time to match their efforts, their wages and salaries, to your revenue. So the adjustments are, as I said, deferrals and accruals. So existing balances are changed. So deferrals are things like supplies and prepaid rent, prepaid insurance. Those are all deferrals. I also group depreciation into that because that's an asset that has already been recorded. It's on the books. We just now need to depreciate that long-term asset to expense it during the period. And then accruals are new information. So this is accrued revenue, a debit to accounts receivable, a credit to fees earned, accrued expenses, like I was just talking about, wages and salaries, utilities, taxes, interest, and the like. Okay? And then you come up by adding and subtracting those debits and credits to the unadjusted trial balance, you come up with an adjusted trial balance. Then that column can be split into the two major financial statements. So you take all of the adjusted trial balances, the account balances, and you split them, all the revenues and expenses, to the income statement, and then all of the assets, liabilities, and stockholders' equity to the balance sheet. Okay? So balance sheet and income statement are the last two columns of that accountant's worksheet. All right? So, from that, you can produce the income statement. So this is a single-step income statement in that it groups all of the revenues, comes up with a total, and then groups all of the expenses, and that's what I was doing back in Chapter 3, demonstrating on the board. Then it calculates net income, in this case, $7,105. That goes to the retained earnings statement. So it comes in, and this was the first 2 months of operations for this company, Net Solutions. So the retained earnings in January or November 1 are 0. We just calculated on the income statement that $7,105 in net income. And then we subtract the dividends that we paid back to the shareholders, the common stock owners. And then that gives you retained earnings at the end of the year. And then that flows to the balance sheet. So that's the interconnectivity between the three. Now in this chapter I want to introduce this form of the balance sheet. It's called the proper form, and it's also referred to as a classified balance sheet. All right? So that's the big takeaway, other than the accountant's worksheet. That's the big takeaway from Chapter 4, is this introduction of a classified balance sheet. So the classified balance sheet, for purposes of this class, has two types of assets. Current assets, and then property, plant, and equipment. All right? Current assets are cash, what you're going to turn into cash, what you're going to sell, and what you're going to use up in the next 12 months, or an operating cycle, whichever is longer. All right? So it's cash, what you're going to turn into cash, that's accounts receivable in this case. What you're going to sell, now this is a service company, so they don't have any inventory to sell, so there's no inventory here. And then what you're going to use up. What are you going to use up? You're going to use up the supplies, and you're going to use up the prepaid insurance. Current assets are the only one on the balance sheet that are listed in a specific order. They're listed in order of liquidity. So what's liquidity? Anybody know?
Like how fast you can get like your hands on the money.
Yes, exactly. How close to cash is it? All right? Liquidity is how close to cash. So cash is always going to be listed first. If you had a short-term investment, like you've invested in some stocks or bonds that you can easily sell, a short-term investment would be next. A notes receivable would be more liquid than accounts receivable, because that's a legal document. That's a promissory note that your customer has signed. And then accounts receivable. So that's what you're going to turn into cash. And then the inventories. What are you going to sell? Well, if you're a manufacturing company, you have three types of inventory. You have raw material, you have work in process, and then you have finished goods. Okay? And then what are you going to use up? Supplies and prepaid insurance. Now, an operating cycle, and there's a slide on this later, but I'll go ahead and introduce it now. An operating cycle is from the time you outlay cash until you get cash back in. So going back to the manufacturing example, if you're a manufacturing company, you go out and you buy raw material. You're paying cash. Cash is going out the door to buy this raw material. You're then paying your employees to convert this raw material into your finished goods through your manufacturing process. You're outlaying wages. So that's cash out the door. Then it becomes finished goods. You sell it to your distributor or to your eventual customer. Give them terms so that they have time to process the invoice and get you a check and pay you. And then cash comes back in the door. That's an operating cycle. Most companies' operating cycles are 30 to 60 days. Most companies. Some are not. Boeing, can take 5-6 months to build an aluminum-style airliner from the time that they first start milling the big spar and the central spar, and then start putting ribs in it and the like. So it could take a while with Boeing. So they have a long operating cycle. Dell actually has a negative operating cycle. When you order a Dell computer, you pay for it before they actually requisition all of the pieces for it. And most of the suppliers for Dell are located either within their manufacturing facilities or directly adjacent to. And then they get 15 days to pay for it. So your machine has already been paid for. The cash has been collected before Dell outlays any cash for labor or parts. So that's a negative operating cycle. We sat here and had all sorts of philosophical discussions amongst the accounting faculty to come up with an example of an operating cycle longer than 12 months. Because the rule is that current assets are within 12 months or an operating cycle, whichever is longer. So try to think of an operating cycle longer than 12 months, and we couldn't come up with one until one of the professors finally at lunch blurted out, "I got one. 12-year-old Scotch." That's an operating cycle longer than 12 months. All right? It takes longer, by the time you start distilling it, buy the corn and all that, and then put it in oaken cast and let it sit there for 12 years until it ages, and finally you sell it. But that's a very unusual circumstance. All right? Property, plant, and equipment is tangible, long-term assets. Assets with physical substance. All right? Land, buildings, stores, warehouses, delivery trucks, manufacturing equipment, computer equipment, furniture and fixtures, tables and chairs and the like. All right? Land is not depreciated, and in this example they've got some office equipment, and office equipment is depreciated into this contra asset account, accumulated depreciation, which is the sum of all depreciation taken. And then the classified balance sheet liabilities, there's two possible liabilities. There's current liabilities, which is everything that is due and payable within 12 months or an operating cycle, whichever is longer. And then long-term liabilities, which is due and payable beyond that 12-month period. All right? So two possible types of liabilities, current and long-term. And one loan can have both. If you have a term loan, like a mortgage or a car payment, that's both. Because you're going to be making payments during that 12-month period. So the principal that is due during that 12-month period is a current liability. Everything that is due in month 13, 14, and beyond is a long-term liability. So one loan could be listed in both categories. And then there are two classifications in stockholders' equity. Contributed capital, which is the amount of money that the shareholders have given to the corporation. So that's common stock, could be preferred stock, could be paid in capital in excess of par, and then retained earnings. All right? So for purposes of this class, there are two types of assets, current assets and property, plant, and equipment. There are two types of liabilities, current liabilities and long-term liabilities, and then two types of stockholders' equity, contributed capital and retained earnings. Okay, so current assets, as I said, are cash, what you're going to turn into cash. They list both accounts receivable and notes receivable. What you're going to sell, there's no inventory once again in this example. And then what are you going to use up? And that's supplies and other prepaid assets, prepaid expenses. All right? Usually sold or used up are converted into cash in 1 year or less. Just a slide on notes receivable. This is just a more legal representation of monies owed to you from your customers. It's a promissory note. It's a legal document that they have signed that gives you higher collectability than just a regular accounts receivable. The property, plant, and equipment, long-term fixed assets, tangible fixed assets that depreciate longer than a year. Current liabilities includes accounts payable, notes payable, wages payable, interest payable, and then unearned fees. This amount that has been deposited to you by your customers for services or merchandise in the future. Okay? And then long-term liabilities are oftentimes formal. They're oftentimes a note receivable, a mortgage, a note payable, a mortgage payable, could be a bond that we sell, and we have a chapter on that after the third midterm that we'll be talking about long-term bonds and their valuation when we get into the time value of money. And then stockholders' equity. So stockholders' equity is their rights, the owners of the business, their rights to the net assets, the assets minus the liabilities of the entity. All right, so here's the accounting cycle. So the accounting cycle we started with business transactions. So a business transaction occurs in chronological order. We analyze those transactions. We classify them into a minimum of 2 accounts, 1 debit and 1 credit. We then record those in a general journal. So chronologically, as they occur, as we receive inventory, as we sell items, as we pay wages and salaries, we record them, and then we post those individual debits and credits to the individual account ledgers. The accounts have each a ledger to themselves. So there's a ledger for cash, there's a ledger for accounts receivable, there's a ledger for supplies, there's a ledger for prepaid insurance. Then we make an unadjusted trial balance. That unadjusted trial balance is then, in our case going forward, we're going to put that into an accountant's worksheet, an end of period worksheet. And I'll show you an example of that here in a second so that you can kind of get an idea as to where you're going with that. Then you're going to make a series of 4 possible adjustments. A deferred revenue and a deferred expense. This is cash has already changed hands. Or an accrued revenue or an accrued expense. This is items that are new, have not yet been recorded. Then you have the adjusted trial balance, and financial statements are then prepared from that adjusted trial balance. You split them between the 2 major financial statements, the income statement and the balance sheet, and then prepare the financial statements. All right, so here's the whole thing. So you're analyzing transactions, writing them in a journal entry, posting those entries to the individual account ledgers, preparing an unadjusted trial balance, adjusting them, then getting a adjusted trial balance, and then creating the financial statements, the income statement, the statement of retained earnings, and the balance sheet. All right, so for this fictitious company in your textbook, Kelly Consulting, they have a chart of accounts. This is a listing of all the assets, liabilities, stockholders' equity, revenues, and expenses that they need in order to analyze these business transactions as they occur. They are always numbered. Account numbers are always numeric. They're never alphanumeric because the people who do data entry use their right hand on that 10 key on the right side of the keyboard. And so they're always numbered. Assets worldwide are ones. So they have cash, accounts receivable, supplies, all the way down through this contra asset account, accumulated depreciation. They have 3 types of liabilities: accounts payable, salaries payable, and unearned fees. Common stock, retained earnings, and dividends are the stockholders' equity. Revenue, they only have fees earned. And then they have 6 types of expenses: salaries, rent, supplies, etc. All right? So here's the journal entries. So debiting cash, accounts receivable, supplies in exchange for common stock, paying for prepaid rent, paying for prepaid insurance. So these are all the chronological journal entries that occurred throughout the period in time. Those then get posted to the individual account ledgers and come up with an unadjusted trial balance. Make your adjustment on your end of period spreadsheet by debiting and crediting for your deferred and accrued revenue and expenses. Come up with an adjusted trial balance. Here's the adjustments. So taking insurance expense for the deferred expense for prepaid insurance, same with supplies, depreciation expense. Accrued salaries, this is an accrued expense. Rent is a deferred expense. This is a deferred revenue. We've earned this $2,500 in fees, and we need to lower the liability and take that to the income statement. That gives you your adjusted trial balance. Income statement, calculating net income, flows to the statement of retained earnings, and ending retained earnings flows to the balance sheet. All right, fiscal years. Most companies operate on a calendar year basis. So 12/31 for most companies is the end of the year. Not all. The NFL, for instance, has an end of period at the end of February. Why is that? That's where the season ends, exactly. So they want to get the entire season into a single year. Many retailers, like Apple, Walmart, Target, have a January 31st year end, because their prime season is Christmas, and then at all the exchanges and post-Christmas sales that go on in January. All right? So it does not have to be a calendar year. It is almost exclusively a 12-month period of some sort. Okay? So the fiscal history is that, we go through each year. The income statement measures the activity. It is measuring the period of time, whereas the balance sheet is a snapshot. So the income statement can be thought of as a video, measuring everything that goes on, revenue and expense-wise, whereas the balance sheet is a picture in time, the assets, the liabilities, and the stockholders' equity. So the spreadsheet is, and I'll just show it to you. Here's the entire spreadsheet. And this is posted on Blackboard for you to use as an example. And I'll pull up the Blackboard site here in a second and show you where the assignment and everything is. All right? So you put in the unadjusted trial balance. This is given to you in the problem. There's a series of adjustments. My recollection is that there's like 7 or 8 adjustments that need to be made, deferrals and accruals. You put those in, add or subtract. So if it has a debit balance and you're debiting the adjustment, you're going to add it. If it's got a debit balance and you're crediting the adjustment, you're going to subtract it. All right? So if it's opposite. So like here's a liability, has a credit balance, we're making a debit adjustment, that's lowering the liability. Fees earned has a credit adjustment, a credit balance, we're making a credit adjustment, that's increasing it, we're adding it. All right? And that will provide you with the financial statements.